Economic survey with the first chapter, that is the state of the economy 2022-23 recovery complete. Now, global economic shock in the third decade of this millennium have presented various economic challenges such as inflationary pressure, depreciation of most currencies, widening of current account deficit. It all started with the pandemic induced contraction of the global output, followed by the Russia Ukraine conflict, leading to worldwide surge in inflation. The frailties of the Chinese economy further contributed to the weakening the growth forecast. For advanced economies in particular, the enormous fiscal stimulus earlier injected by their government supported a strong demand revival. The Indian economy, however, appears to have moved on after its encounter with the pandemic, staging a full recovery in FY22 ahead of many nations and positioning itself to ascend the pre pandemic growth path in FY23. Yet, India has also faced the challenges of reigning in inflation that the European strife accentuated, widening current account deficit and rupee depreciation. Global economy battles through a unique set of challenges. COVID-19 pandemic was the first challenge of the third decade. Russia-Ukraine conflict broke out in February 2022, accelerating existing inflationary pressures. Monetary tightening by nations to rein in inflation drove capital flow to safe havens like US markets, contributed to rising sovereign bond yields, and depreciation of most currencies against US dollars. Prospects of global stagflation and a consequent protectionism by nations slowed cross border trade. Chinese slowdown induced by its policies, that is zero COVID policy, scaring from the pandemic brought in by the loss of education and income earning opportunities. Russia-Ukraine conflict implications, disrupting the restoration of supply chain, disrupted up here by lockdown and limited trade traffic. Rise in prices of critical commodities such as crude oil, natural gas, fertilizers, and wheat. This strengthened the inflationary pressure that the global economic recovery had triggered, backed by massive fiscal stimuli and ultra accommodative monetary policies. Led by the US Federal Reserve, central banks have been hiking policy rates and rolling back liquidity to rein in inflation. But as the impact of monetary policy action is felt with a lag, inflation rates remained stubbornly high during the early phases of the rate hike cycle but have begun to decline lately. Impact of inflation, a hardening of bond yields across economies, outflow equity capital from most economies around the world into traditionally safe haven markets of the US. Capital flight subsequently led to the strengthening of US dollars against other currencies, widening the current account deficit and increasing inflationary pressure in net importing economies. Led to a slowdown in global output beginning in the second half of 2022. Macroeconomic and growth challenges in the Indian economy. The impact of pandemic in India was seen in a significant GDP contraction in FY21. The third Omicron wave did not affect as much as the previous waves. Mobility enabled by localized lockdowns, rapid vaccination cover, mild symptoms, and quick recovery from the virus contributed to minimizing the loss of economic output. Consequently, output in FY22 went past its pre pandemic level in FY20. India's economic resilience and growth drivers. Economic resilience. Many agencies have been revising downwards the Indian economy's growth outlook in FY23 due to monetary tightening by RBI, CAD widening, and plateauing growth of exports, all of which are results of geopolitical conflict in the Europe. Further, a capex thrust in the last two budgets of the government was not an isolated initiative meant only to address the infrastructure gap in the country. It was part of a strategic package aimed in crowding in private investment in an economic landscape broadened by the vacation of non-strategic PSEs, that is disinvestment, and idling public sector assets. Forecast for Indian economy, including NSO's advanced estimates, lies in the range of 6.5 to 7%, which are higher than almost all major economies. IMF estimates India to be in the top two fast-growing significant economies in 2022. Such estimates for the Indian economy, that too without advantage of base effect, are a reflection of India's underlying economic resilience, of its ability to recoup, renew, and re-energize the growth drivers of economy. Domestic stimulus. India's economic resilience is visible from domestic stimulus to growth, that is domestic consumption, and replacing the external stimuli, that is export growth. Initially, manufacturing and investment activities gained traction due to export surge but by time exports growth moderated. As a result, private consumption stood at 58.4% of the GDP in second quarter of FY23, highest among second quarter of all years since 2013-14. New universal vaccination coverage led to better contact based services, which contributed to better consumer sentiments. So it not only saved lives but also contributed to recovery and growth of economy. Release of pent up demand supported rebound in domestic consumption, which is evident from accelerated growth in personal and housing loans, decline in housing inventories, etc. Capex development of central government and its public sector enterprise has led to a rise in activities like construction in FY23. States also have a larger capex supported by center's grant and aid for capital works and an interest-free loan repayable over a 50 years period. Capex thrust in the last two budgets of the central government was part of a strategic package aimed at crowding in private investment into an economic landscape broadened by vaccination of a non-strategic public sector economic enterprises vacation sorry disinvestment and idling public sector assets. This capex thrust was supported by buoyant direct tax collection and GST collections, ensuring full expending of the capex budget within budgeted fiscal deficit, pickup in private sector investment since fourth quarter of FY22, strong corporate balance sheet through recovery in investment and manufacturing activities of corporate is attributed to increase in export demand, rebound in consumption and public capex. Strength of banking sector has fulfilled the increased demand for credit. Year-on-year growth in credit has moved into double digits and is rising across market sectors. Example, credit growth to MSME sector has been 30%, over 30% during January-November 2022, supported by extended emergency credit linked guarantee scheme of central government. Increased credit supply by banking sector is due to their improved financial health, which is a result of fast tracking of NPAs for quicker resolution by Insolvency and Bankruptcy Board of India, and capitalization of PSBs by budgetary support. Raising yields on corporate bonds and higher investment hedging costs on external commercial borrowings have made these instruments less attractive for debt financing in FY23, and this gap is filled by financial strength of banks. Regarding inflation, RBI projects headline inflation at 6.8% in FY23, outside target range of 6%, but is not high enough to deter private consumption and also not so low to weaken the market low as to weaken the inducement to invest. Moderately high inflation has ensured anchoring of inflationary expectations, preventing prices from weakening demand and growth. With inflation on a declining path, interest cost of domestic credit will likely decline, inducing a further increase in demand for credit by corporates and retail borrowers. Inclusive growth that is creating jobs is visible from the PLFS data, that is Periodic Labour Survey Force data, which shows urban unemployment rate for people aged 15 and above declined to 7.2% in second quarter of FY23 from 9.8% earlier. Labor force participation rate also improved, indicating the emergence of economy out of pandemic-induced slowdown. Increased job creation is the result of export surge, strong release of pent-up demand and a swift rollout of capex. Outlook for 23-24, India's growth in the upcoming years will be supported by solid domestic demand and pickup in the capital investment. 2010s, financial system stress due to excessive lending in the 2000s, evidenced by rising NPAs, low credit growth, declining growth rates of capital formation. Presently, signs of new private sector capital formation cycle are visible. Also, the government raised capex substantially to compensate for the private sector's caution. Budgeted capital expenditure rose 2.7x in the last 7 years, that is FY16 to 23. Structural reforms such as introduction of GST and IBBIs enhanced the efficiency and transparency of the economy and ensured fiscal discipline and better compliance. India's outlook remained bright, but global economic prospects for the next years are facing challenges, imparting downside risks. As per IMF's World Economic Outlook, global growth is forecasted at 2.7% due to high inflation, monetary tightening, strains in supply chain, and heightening uncertainty from geopolitical conflicts. Ongoing monetary tightening exercise due to entrenched inflation pose another risk to outlook. Due to this, borrowing costs may stay higher for longer. Global economy may be characterized by low growth in FY24. The scenario of subdued global growth represents presents two benefits to India: low oil prices and better current account deficit. That'll be it for the first chapter.